Hi, it's Carl Allen. Welcome to module number 5, lesson number 2. Now in lesson 1, I walked you through a typical income statement, a balance sheet, and a cash flow forecast, including some working capital ratios. And today, we're going to build off that and we're going to cover 3 additional topics. Number 1, additional analysis ratios to consider. Number 2, the indicative financing of the balance sheet. And number 3, the valuation methods that we're going to be using in the next lesson. So in addition to the working capital ratios that we discussed last time, here are the other 5 ratios that I look at a business before buying it using an LBO. So quick ratio, the current ratio, the debt to equity ratio or DE, the return on equity ROE, and the return on assets ROA. So let's go through each one. So the quick ratio, it's current assets minus inventory divided by current liabilities. It's a test of how well a business can meet its short-term financial liabilities. It backs out inventory because it assumes that selling inventory will take several weeks or months. So the quick ratio only takes into account those assets that could be sold today or used today to pay short-term debts. So anything less than 1 is bad, as it means the business could struggle to meet short-term liabilities. Now in our example, it's currently 3.67, which is really good. Now the current ratio is current assets divided by current liabilities. That tests the business's ability to pay short-term liabilities with its short-term assets, but in this case, including inventory. Ideally, this needs to be 2 or higher. Again, our target business is 4.67, which again is very good. The third is debt to equity ratio, which is the total liabilities divided by the shareholder equity. That tests the relationship between the amount of capital that's been borrowed, i.e. debt, and the amount of capital contributed by the shareholders, i.e. equity. You want to see this in the 1 to 1.5 range after an LBO. So you're looking for something ideally below 1 before introducing new debt into the business to buy it. Now in our example, it again shows a really healthy business as the ratio is currently only 0.36. So the lower the number, the better. Now that we know that our business has got very low amounts of debt, let's now look at efficiency, namely the return on equity, ROE, and the return on assets, ROA. Now return on equity is the net income after tax divided by the average equity on the balance sheet for the same period. Though this does vary by industry, so 15 to 20% is an ideal range. If it's lower, it's just that the business isn't as profitable as it should be, presenting you with an opportunity. And for our business, ROE was only 10.8% in 2018 as profits dipped, but it jumped to almost 30% in 2019, which is super healthy. Now, return on assets is a similar measure, and it's more important for traditional businesses like engineering, manufacturing, transport, construction, and any business that's real estate backed like a restaurant or even a hotel. So for this, you want to see at least 5%. In our deal, it's an engineering business. It's now at 21%, which again, super healthy. So all in all, despite a downturn in performance in 2018, the business returned well in 2019, and it's really healthy across all of the different metrics. So it's a perfect candidate for an LBO deal. Next, let's look at what financing that we're likely to see for a closing payment. We'll get into the detail of this in module number 7, where we actually go out and raise the financing for the deal. But it's important at this early stage to have some form of financing indication, because that's going to drive the sorts of offers that you're going to make. And we're going to examine this in 3 ways. First, we're going to look at what assets that we have to leverage, and also what debt is currently within the business that we can inherit and as such deduct from the offer that we make to the seller. And then finally, we can see if any of the assets are already likely to be pledged as security covering the existing debt. So let's start with examining the assets in the business. There are 5 primary assets that we look for financing. These are surplus cash, so that's cash over and above what the business needs to comfortably trade. Number 2 is real estate. Number 3 is receivables, which is the book of invoices that have been issued to customers that haven't yet been paid. And you only really see this for a business that's subject to accruals-based accounting, which essentially is most offline businesses, most brick and mortar businesses. Number 4 is inventory, and this is only applicable for inventory sitting within the business under your control. If it's an online business, for example, and the inventory is in Amazon's fulfillment warehouse somewhere, then you can't leverage that asset for financing. It's got to be physically within your premises. And then finally, number 5, plant and equipment. So looking at our balance sheet, and you only look at the latest numbers. If you're looking at a deal that's more than 45 days past the financial year end, which we are in this case, you will need an up-to-date balance sheet since the assets can change significantly year to year. And we get into more detail on that in later lessons. But for now, I just want to show you where these assets are found on the balance sheet. So the real estate, which is owned by the business, is $450,000. And typically that could be financed at around 70%, which would generate about $315,000 for the deal. We also have some plant and equipment at $233,330. This reduces year on year typically as plant and equipment assets, they depreciate in value. You write them off through the income statement. And we could typically raise about 50% on that depreciated value, which in our case would be about $117,000 in this deal. And we have almost $500,000 of cash. And I'll show you in the next lesson how much of that you typically need to run the business. And this early stage in the buying process, we'll estimate about 1 month's sales revenue. So in this deal, 1 month of revenue is 2.9 million divided by 12, which is $244,000. So out of the $500,000 of cash that's available, it's likely after we use the 244 to run the business, we can use the difference, which is $256,000 of cash that we can use to help fund any closing payment. And we also have $547,000 of AR, accounts receivables, an average of about 80% loan to value. That would generate approximately $438,000 of financing. Now, inventory financing depends on the type of inventory, but assume 30% at this stage to be conservative. And in our deal, we've got $293,000 of inventory, so that would generate about $88,000 of financing. So we're probably looking at around $1.2 million and change in indicative financing for buying this business in an LBO. Next, let's look at the debt currently within the business as we can assume it and reduce the offer as a result. So we ignore accounts payable unless it's a direct to consumer business, so a B2C, which will not have any receivables generally. But in most businesses that we inherit receivables for free as part of the deal because we're using it for financing, so we inherit the payables as well. So no adjustments there. However, we do adjust for the bank debt and overdraft. That's almost $113,000. And we adjust for the outstanding amount or higher purchase loans on the equipment, both the short term, $20,778, and the long term, $8,278. And there's also a $250,000 long-term financing note that we definitely need to adjust for as well if we're inheriting it. So all total, the debt that we're going to assume is going to be $391,899. However, it's likely that the installment loan is secured against some of the fixed assets already. And I'm assuming that the bank loan, the overdraft, and the $250,000 long-term financing loan are secured via a debenture or a lien against all the assets in the business. And we need to check that out in a follow-up meeting, as that could lower the financing. You don't do that as late as due diligence. We need to know that now, because that's going to impact the offer and the deal structure. So worst case, we're going to use $391,889 of the $1.2 million in financing to settle those debts, retire those debts, and get that debenture, get that lien removed from the business, which still gives us more than $800,000 in financing for a closing payment. And we'll go into more detail when we model up the deal in the next lesson, and again at the offer stage in module number 6. So finally, let's look at valuation. And there are many valuation methods out there, but only 2 are what we're going to primarily use for doing leverage buyouts. So one method, the enterprise value or the EV method, accounts for more than 90% of LBO deals carried out. And it's essentially a multiple of the business's profit with a few adjustments: surplus cash, debt that you're going to inherit, and any real estate that's coming as part of the deal. Now, we also are going to look at the balance sheet method, and we use the balance sheet method in a lot of rare cases. So this is when you find a business that's got a very, very low profit margin, yet the business is very asset heavy. So in the balance sheet method, we're essentially going to take the net asset value of the business, i.e. the shareholders' funds, and then add back something called goodwill, which is the business's ability to continue to generate revenues and profits going forward. And we calculate that as a very small multiple of net profit or after-tax earnings. Now, those two methods comprise 99% of LBOs carried out in the $500,000 to the $10 million revenue range businesses. And for much larger LBOs, so hundreds of millions of dollars and even billions of dollars, like Hilton, PetSmart, Horizon Entertainment, RGR Nabisco back in the 80s, more sophisticated methods like discounted cash flow or DCF are actually used. And this is more relevant for modeling and valuing publicly listed or very, very large above $100 million businesses and very, very high growth businesses that are looking for venture capital investments. Now, the DCF method forecasts the future cash flows up to 10 years in the future and then discounts them all back to present day value. And if that sounds confusing, don't worry about it. Virtually all the businesses you look at in the $500,000 to $10 million revenue range will only forecast 1 year ahead, if at all, which is why the DCF method just doesn't work for a small business LBO. Now, for more distressed deals, so distressed deals, not distressed sellers, where the business is really struggling and it's in some danger, these are typically valued by just assuming the liabilities within the business and paying, say, $1 for the shares. Let's cover the enterprise value and balance sheet methods in more detail before I introduce the models to you in the next lesson. So first, let's discuss multiples, which for my money are more art than science. So the multiple we're going to be using is a multiple of EBITDA, earnings before interest, tax, depreciation and amortization of goodwill. Now, the average multiple in the US in 2018 was only 2.29, was slightly higher in the UK. Now, at this time of the recording, the 2019 numbers weren't yet out, but I'm expecting them to be roughly the same, somewhere between the 2.5 range. And there are many things that influence the multiple applied to the EBITDA when valuing a business using the EV method. And the first is size. The larger the EBITDA, the larger the multiple, it compounds. That's why public companies who have EBITDA in the hundreds of millions or billions can command a 10x, even a 20x, even a 30 to 40x multiple, like Apple or Microsoft. Amazon's at a 100x multiple, Tesla even higher. Now, the other variables come down to how niche and specialized the business is, how much it's growing, and the strength of any intellectual property in the business or barriers to entry generally for somebody coming in and entering the market. Now, if a business is essentially commoditized with little to no growth, no barriers to entry, so pretty much anyone can start up in the business and it's got really low margins, poor optimization, then those businesses, they're not even really going to command even a 2x multiple. But on the other hand, if the business is growing like crazy, it's got really high profit margins, really high barriers to entry, and really strong IP, like say unique software business or a patented medical device, those things can really drive up the multiple. And for our purposes, we're looking at a maximum 3 times multiple of EBITDA, and calculating the enterprise value is as simple as using the average EBITDA across multiple years, then multiplying by 3. And then to generate the value of the shares, we add items like surplus cash, real estate, and other non-operating assets, but then subtract the debts, the liabilities that we're going to inherit. And you'll see how all of this works in the next lesson. The model does all of the calculating for you. Just plug in the basic numbers. Another item that affects the profit levels is something called add backs. Now, add backs are expense items that get added back to the profit line to reflect how income is going to increase when the owner has left the business and now you own it. And this better reflects something called normalized recurring profits by ironing out any kind of lumps in there from one-off costs. And add backs are always a big major point of negotiation. Brokers in particular will add back kind of everything they can think of. So we'll always negotiate the add backs down to something more real and sensible. And examples of legitimate add backs are, say, the owner's salary. If it's excessive and it's above the market rate of a general manager to run the business. And typically will agree to those. And also the owner's benefits that will not reoccur, like pension contributions or 401 contributions, car payments, health insurance, unless this is needed as part of the benefits package of the new GM that you might put into that business or division to run it. Also, personal expenses that are put through the income statement by the owner. A little bit naughty, but you see this a lot. But be careful, as often owners can really put through some excessive expensive, like vacations, household expenses, and even expenses for other family members. And excessive misuse of this is essentially tax avoidance. And if you're buying the shares of the business, you'll need indemnities around this from the seller. And we get into that as part of deal execution process in module number 8 when we get into the legals. And there are a lot of ways around it, so don't worry about it now, but just wanted to make you aware. Now, owners may have other family members working in the business, and they will also leave as part of the deal, and if they don't need replacing, then these are also legitimate add backs. However, some brokers may try to add back, say, bad debt. Debts that have been written off where the business has had customers, they haven't paid, or that customer's gone bust. They've written off that debt and then they add it back to increase the profit. And I never agree to those, since those kind of write-offs, and you'll know this as a business owner, they're just kind of part and parcel of owning a business. It's just a cost of being in business. You have to expect a little bit of that. And I also resist any add backs for, say, one-off big marketing expenses, since those will typically have increased the revenues and the profits, which you've already accounted for as part of the business's valuation. So I always resist those as well. I also reject any professional fees. Again, that's part of the cost of doing business. We all need professional advice from time to time, whether it's the CPA cost or legal costs or whatever. Now, a debatable one is when the owner invests to improve the facility. And typically that's a capital expenditure, and it's not expense through the income statement, but sometimes it is, and those will allow. It all comes down to negotiation at the end of the day, and we'll get into that in great detail in module number 6. In fact, you'll see in the next few lessons and in module 6, offers and negotiations, that the structure of the deal is actually more important than the valuation applied. But let's look at a simple add back example. So from the overhead summary, here are the add back categories that you'll see from the detailed income statements. Now, this is what the broker submitted: full add backs for the owner's salary, one-off marketing expenses, the facility upgrade, bad debts, family members, personal expenses, and charitable donations. It's $142,000 of profit increases in 2017, $155,000 in 2018, and $254,000 in 2019. That's going to materially increase the valuation. But then here's what was negotiated. So for owner's costs 2017-2018, this was actually a reduction in profit because the owner of this business was taking a very low salary and instead taking cash out through shareholder distributions, which these are below the EBITDA line. So we don't need to adjust for those distributions. But a market rate for a GM for this engineering business is about $100,000 a year. So since the owner only paid himself $50,000 in 2017 and $75,000 in 2018, I actually reduced the profit by $50,000 and $25,000 respectively. In 2019, the owner paid himself $150,000. So that's a legitimate $50,000 add back, but just in that 1 year. That's the $150,000 he paid himself less the $100,000 per year cost for a GM to replace him. And I rejected the one-off marketing expense as well as the bad debts and the salary of the family member who was a part-time bookkeeper, because that role needs to be replaced at the same salary. Now, facility maintenance was agreed, as were personal expenses and charitable donations. So the agreed add backs were much lower than what the broker provided, but higher than the overhead summary, thereby maintaining a sensible valuation. Now, here's how they look side by side. The green is the higher profits with all the broker add backs. The blue is the profit as per the accounts with no add backs, and what was negotiated and agreed, the red, somewhere in the middle. Next, this is the enterprise value, the EV model that I'll walk you through in the next lesson. This is going to save you so much time. Your CPA or your internal financial person may have their own model, but mine has been tried and tested on hundreds and hundreds of deals. And here's the balance sheet method model. Here we use the net asset value, the shareholders' funds, shareholders' equity off the balance sheet, and apply a small multiple to taxed profits to generate that little goodwill portion. And I typically use about half the multiple versus what I use in the EV model. So in this deal where I may use a 3x multiple for the EV model, I would use 1.5 times the net profits, the taxed profits for goodwill in the balance sheet method. And here's the balance sheet model that I'll walk you through in the next lesson. So you want to typically run both to see how the valuations compare. Now, the final model that you'll see is the merger model. The merger model helps you forecast the cash flow and the valuation upside when you integrate your new business into your existing one and you drive those cross-selling synergies and those financial synergies that we discussed in an earlier lesson. And this creates what I call the merger value gap. And we'll review the merger model in greater detail coming up in lesson 4. So your total valuation post-merger and integration is red. Blue is the current standalone value of your business. The orange is the standalone value of the target business that you are buying either via the EV or the balance sheet valuation method. Green is the value you generate via cross-selling, and grey the value you will generate via those cost synergies. So that's it for this lesson. We did some further analysis on the target business's health with some common financial ratios. We looked at the indicative financing potentially available from the balance sheet. And finally, the 3 valuation methods that we will adopt: EV, balance sheet, and the merger model. So I'll see you on lesson 3, where we'll really start to dig in to those valuation models. So until then, bye for now.